Welcome back to The Explainer. Today, we are diving into a truly landscape-altering event in the industrial sector. We're talking about the massive acquisition of UniFirst by Cintas. Now, if you evaluate businesses based on durable competitive advantages, what we value investors call an economic moat, you already know UniFirst is a heavyweight in facility services. But this buyout, it completely shifts the paradigm. So let's unpack exactly what this means for the underlying business quality and, more importantly, your portfolio. Right out of the gate, we have to talk about the buyout figure that absolutely everybody is laser-focused on. Cintas is offering $155 in cash plus 0.7720 shares of their own stock for every single share of UniFirst. It's a massive premium, and honestly, it gives current shareholders a really interesting mix. Immediate cash liquidity right in your pocket, coupled with ongoing equity and what's going to become an absolute compounding machine of a combined company. But a deal of this magnitude really forces us to take a step back and ask a bigger question. What actually happens when an industry giant swallows its main rival? Because this doesn't just change a stock ticker on the exchange. It fundamentally alters the pricing power, the economies of scale, and the competitive dynamics of the entire industry for decades to come. Section 1. The Cintas Acquisition. Let's break down the exact mechanics of this payout structure. It's cleverly constructed as a tax-free reorganization, which is great news because it means you avoid an immediate tax hit on the stock exchange portion of the deal. So for every share of UniFirst you hold, you're getting that $155 in hard cash plus those Cintas shares. And if you're wondering about messy fractional shares left over, don't worry, the deal accounts for that. Any fractional shares are just going to be paid out directly to you in cash. Now, because of the sheer size disparity between these two businesses, the post-merger ownership split looks, well, pretty lopsided. Cintas shareholders will own about 96.6% of the combined entity, leaving UniFirst shareholders with a 3.4% stake. But let's put that into perspective. 3.4% of a sprawling, dominant industry juggernaut is still an incredibly lucrative piece of the pie to hold on to. Mechanically speaking, this is a two-step merger process that ultimately ends with UniFirst being delisted from the New York Stock Exchange. But here is the absolute linchpin of the whole deal, the Croati family. They control roughly 2/3 of UniFirst's voting power, and they've already signed an agreement backing the buyout. With that level of insider support locked in, the path to closing in the second half of 2026 is practically paved and ready to go. Section 2. UniFirst Core Business. To really understand why Cintas is paying up for this, we have to look at the economic moat UniFirst has built. This is far more than just a laundry company. They bring a massive, incredibly reliable network of recurring revenue. We are talking about 270 service facilities, outfitting workers at over 300,000 customer locations. They dress literally over 2 million workers every single day. Add in their first aid division and their highly regulated, specialized nuclear industry services, and you're looking at a tremendously wide infrastructure moat. Just look at how that moat translates to the top line for the full 2024 fiscal year. UniFirst's core laundry operations are an absolute cash cow, generating over $2.14 billion all on their own. The specialty segments add another $288 million on top of that. As a value investor, this is exactly what you want to see: incredibly stable, high-volume, highly predictable recurring revenue. Section 3. Recent Financial Performance. Let's dig into the earnings quality, starting with their Q2 2026 numbers. At first glance, things look really solid. Top-line consolidated revenue grew by 3.4%, reaching over $622 million for the quarter. And that growth wasn't a fluke. It was largely driven by strong organic growth and winning new accounts in their core uniform services. But here is where we hit a bit of friction. Their operating margin actually dropped to 4.2%, down from 5.2% the year prior. Because of that margin compression, net income got squeezed down to $20.5 million for the quarter, compared to $24.5 million the year before. So top-line revenue is growing, but bottom-line profits are shrinking. So what's causing that disconnect? Well, when we look under the hood, we see that heavy internal investments severely compress their short-term profits. They essentially took a hit to overhaul their corporate software, spending $3 million on an ERP system rollout and digital transformation. Add to that $2.5 million for a legal employment matter and another $2 million strictly for proxy and merger-related costs. It takes capital to modernize a business and to execute a merger of this size, and those one-time costs definitely chewed into current profitability. Section 4. Dividends and buybacks. A hallmark of a wonderful business is capable management that allocates capital well, and UniFirst has proven that. They have built a rock-solid, 7-year track record of consistently increasing their dividends. In fact, over the last 5 years, that growth has averaged nearly 10% annually. Today, the stock pays out an annual dividend of $1.46 per share. It's a really nice little yield kicker for investors who are choosing to hold the stock through this whole transition period. On top of that, the board recently flexed its capital allocation muscles by authorizing a massive $100 million share repurchase program. This actually rolls in the remainder of an older program, but it gives the company significant financial firepower to support their intrinsic value on the open market, whether that's through open market buys or privately negotiated transactions. Now, with those recent margin pressures we discussed, you might naturally be asking, can they actually afford to keep up these dividends and buybacks? Well, comparing the payout metrics makes the answer abundantly clear. The dividend is incredibly safe. They are paying out less than 20% of their trailing earnings. Even better, they are using an astonishingly low 9.06% of their operating cash flow to fund it. The underlying cash generation engine of this business is just phenomenally strong. Section 5. Wall Street Forecasts. So how is the street pricing all of this? Right now, the analyst consensus leans heavily toward a hold or reduce. Out of 5 analysts, 4 say hold and 1 says sell. And the reason is pretty simple arbitrage logic. The stock is heavily anchored to the pending merger price, trading right around $252. That is well above its historical average intrinsic value price target of $228. Analysts aren't saying the underlying business is bad, far from it. They're just pointing out that the current stock price already has the buyout premium fully baked in, leaving very little traditional upside on the table. Section 6. What happens next? The road to closing this deal involves 3 main hurdles. First up is the formal shareholder vote on the merger agreement. Though with the Krawati family's massive voting power backing it, this is largely a formality. Second, they have to clear the necessary regulatory and antitrust approvals. And third, the final conversion where your shares become Cintas stock and cash, followed by UniFirst officially delisting from the NYSE. The target for wrapping all of this up is the second half of this year. And that leaves us with the ultimate value investing question for anyone holding the stock right now. Do you hold out to receive the final Cintas shares and the $155 cash payout, banking your capital on the future economic moat of this combined mega company? Or do you take your margin of safety right now, locking in your gains by selling on the open market today at a guaranteed premium? It is a classic arbitrage dilemma. So, what is the smartest capital allocation move for your portfolio today? Thanks for joining me for this explainer, and I'll see you in the next one.